Thank you.
Okay, thank you for joining us. Brent, you want to start?
Yes. So first and foremost, thank you, everyone. We appreciate your time today. The presentation, as everyone's aware, is going to cover some of the common issues and matters that we see within the food and beverage group, consumer products. And today, we hope that you can walk away with at least one item as a takeaway that is beneficial to you in your business. So first and foremost, Steve Plattman and myself, Brent Lessey, we're both partners here at Anchin. We are members of the food and beverage group. I always say that, quite frankly, we just operate on two different sides of the same coin. A little bit about Anchin here. So our CPG practice covers about 300 clients, plus or minus. It has about 40 professionals within the group. We have annual events and industry events, a state of the food industry event, as well as a CPG. And with regards to our clients, quite frankly, although our main corporate office is located here in New York City, our clients are national. And on this slide here, what you can see are some of the clients that we have been involved with from inception to a successful exit. Many brands that are well known and fans of within the industry. Next slide. So a little bit about the food and beverage industry, specifically on branded food companies. This is the typical life cycle that we see. Many clients start off as early high stage growth, backed with smart money, institutional dollars. And as those companies grow, they become mid-stage and also exit stage. Now, one thing I'd like to point out, nothing against Steve Plattman here, but as you go through this process, if there's one common thread here, is tax strategies that occur at the beginning, that occur at the mid, and quite frankly, are even more important for a successful exit. Go ahead, Steve.
And let me add to what Brent said before. At the early stage, high growth area, we often get clients who are either pre-revenue or have very small amounts of revenue, and we're talking less than $2 million. So we have taken clients on at that such small level. And as Brent alluded to, tax is the main focus at that level. However, I will tell you that from a financial outcome or how it works is you want to make sure that you have all your eggs in a basket, you have the proper tools to put out financial information. So a lot of companies say, what's the best accounting package to use, whether it's QuickBooks, NetSuite. We've been asked those questions also, and we usually say, go to a QuickBooks program. It's the easiest way to get started. And we also get involved in helping them put together a balance sheet and income statement foundation, which will help them analyze their business at that early stage growth. And as they go through the various stages, the mid stage and exit stage, which Brent will discuss, the sophistication and issues and questions get even harder, because now when you get to the point where you bring in outside money, the level of the playing field changes and the accuracy of the information is even more prevalent. So I'll turn it back to Brent to discuss the mid stage and exit stage.
Correct. And also, Steve, one other item, quite frankly, one area that we've provided some benefits to clients is, quite frankly, on a basic level with regards to accounting. And what I mean by that is what is treated as above the line and what's treated below the line. There are rules out there under GAAP with regards to what should be included in your gross profit margin and what shouldn't. And quite frankly, if you're out there looking for smart money, looking for capital, these investors are looking at these metrics to assist them in valuing your business. So you want to ensure that expenses are being allocated and reported in the right buckets, so to speak. Ashley, next slide. Steve, I will hand it off to you here.
Yes. Does anybody have any questions? I mean, we'll have time for the end. Does anybody have any questions as of now? You can come off mute, you can come off mute or put in the chat. Okay, no questions. Okay, so the emerging brands. Now, Anchin's food and beverage practice is broken up into different categories. Brent and I spend most of our time in the emerging brands. And what that really means is that when you walk into a Whole Foods or a store or Costco or any of those stores, it's a packaged product, whether it's a beverage, a snack, or a frozen aisle. And most of the companies in the emerging brands are founders who are usually on the younger side, and they just said, I have a great idea, and then they're off to the races. So what we always tell our emerging brands is the first thing they should look at is develop a proper financial and tax structure. That's very important early on, and we'll discuss some of that detail later, but it's a very important concept of whether you want a C Corp or an LLC. Now, you would probably contact your legal counsel and your attorneys to get all this put in place. But sometimes a lawyer will say, okay, what do you want to be, a C Corp or an LLC? But from our side, as being the accountants and the tax providers, there is a very big difference. And we get a lot of detail of the differences between the C Corp and an LLC structure. And we can discuss that further. We're also there for supporting the rapid growth of your brand. Now, as accountants and tax providers, people look at it and say, okay, you do my tax return. There is so much more that we provide our clients. Yes, we do the compliance work, which everyone has to do, but we're there as a sounding board. We have over, as Brent mentioned, over 300 branded clients. So we know best practices. We have seen mistakes. We have seen issues come up. We want to make sure at the youngest possible level that you're set up for success. We'll get involved in reading your agreements, your co-packer agreements, any document that you want us to look at. We will give you our comments. But we also, which also is a good thing for us to do, we have friends out there. So if you're looking for somebody who wants to be a branding partner or a marketing agency, or even looking at where to set up the business, warehousing, we have friends in the industry, very collegial in this industry, and we can refer you to many people in the industry. Everybody, insurance, legal, branding, co-packer agreements, you name it, we know people in the industry. And it's a nice way to talk, to help your friends out. So we also, dedicated staff takes accounting issues off your plate. We can get involved in every part of your business, looking at your situation. We have as dedicated staff people in the CPG group, the emerging brand group, who know these issues. We have set up a emerging company platform in our firm that helps small companies handle all their issues. I mean, I can tell you right now is we answer the most minute questions about 401k plans, structure, should I do this, help me, sales tax issues come up. That's what we're here to help you with. And we can provide you the tools and information needed to make better decisions. Again, we have best practices. We can look at your gross profit. We can say that's not industry standard. We have a evaluation group that can say, well, if you do it, what are common themes? What are other exits, multiples? We're there to help you on all those issues also. So we look at it we want to be there from startup to I call touchdown. And touchdown means a successful exit. And Brent, we had a slide earlier, we've been involved in several successful exits in the last, I've been involved here 10 years. There's probably more than that, but we've been involved in every step of the way. Next slide. As I alluded to earlier, measuring your business. We like to look at your business from these 6 angles: the SKU level, the customer level, the channel level, gross margin level, net sales, and contribution margin. Each of these has its own little nuances. I can tell you right now, before COVID, most people were discussing the channel as being mostly retail, wholesale. That is so different now with the direct-to-consumer channel growing exponentially. More and more clients are coming to us and saying, we want to get into the D2C model, and can you help us? and we get them in the right direction. We have consultants out there we use for channel consulting, but more D2C is out there, and that brings up a lot of issues on the tax side. By customer, we will look at your business from a customer level. We'll say, show me your analysis by customer. Are you really making money from a gross profit perspective? What is your issue? Are they taking deductions? What is out there? SKUs. Now, somebody like me, and I like to go shopping. Okay, people laugh at me. Says, "What do you do on the weekends?" I like to walk into a store, look for my clients' products, and say, "Hey, great display, great placement," and they love that stuff. They love that I'm out there looking at products and looking at the costing of the product. Because I can tell you, I know how much money it costs to make a product. Are you really making any money on this product? Gross margin. Brent alluded to this earlier about what's above and below the line, and this is a major pain point for clients who try to get their gross margin to be as high as possible. There are rules out there related to where it belongs, whether it belongs above the line or below the line. I'm going to give you the classic example of the above the line versus gross below the line. There are certain deductions, and we'll talk about this later also. There are certain deductions and expenses that companies are saying, no, this belongs in the marketing expense. And we say, no, it does not. It belongs as a reduction of your revenue. And we get into very lively debates about these rules. And there's guidance out there, and we usually point them in the right place. And that we tell them, listen, we're telling you from a compliance and rules-based approach, this is the right treatment. You want to put it there above the line or below the line for your management purposes, we're fine with that. But when somebody comes in to do diligence on you, this is going to be one of the first things they discuss and to find out. Net sales. I like to have this conversation on net sales. You could have $1 billion in what's called gross sales, but all people care about is what is your net sales. So there's a lot of numbers that go between gross sales and net sales, whether it's a spoilage allowance, whether it's a promotional item, whether it's discounts, the trade spend deductions, everything you can think of between gross and net is what I care about. So you can say someone, I had a gross sales, $1 billion. You netted $100 million. That's what people focus on. Next slide. Brent?
Sorry, guys. No, that's your slide.
Oh, my slide. Okay, do you have working capital discipline? Working capital is a great measure of somebody's balance sheet. I'm assuming everyone on the call knows what a balance sheet is. Okay, so my assumption is everyone knows what a balance sheet is. Working capital is defined as your current assets minus your current liabilities. What is included in current assets? Cash, accounts receivable, inventory, and what's called prepaid expenses. If you subtract from there your current liabilities. Current liabilities would be your accounts payable, your line of credit at your bank if you have one, and the other liability that's due within the operating cycle, which is defined as the next 12 months. How important is this? Extremely important. This measures your liquidity, how quickly you can turn your assets into cash. Cash is king, as I like to say. How much money do you have in the bank? All I look at is what's your cash. Inventory and accounts receivable is only as good as you can monetize it. So if you can't monetize your AR and inventory, then it's really not a good asset to you. So how quickly you turn it into cash? Because cash is how you measure whether you can make it or not. And I always ask the clients questions, how much cash do you have? I have this much cash. I go, that's not enough cash. Look at your projections. It all flows into your models of your projections, your cash flow model, your financial projections. How much working capital do you have to operate this business? Because if you get too low, and we have clients that have negative working capital, that means they're on the brink of a very big problem. So I try to tell clients, do whatever you can, but conserve as much cash as possible. Do what you need, manage your business, operate your business. Cash is your lifeline. And then if you need to get cash, where do you get it? And then you have to go out and raise capital or raise cash or debt. That's something is your last resort. I always like to say, raising capital is good, but make sure you can plan it and they conserve the cash. I have clients out there who I say, why are you raising cash and capital? Why are you giving away the equity? They say, I don't know. I just want to give people some equity in the business. I go, you don't need to raise capital. Yeah, but I want to have it as a safety net. Those are few and far. In the emerging brand clients that we serve, it's fair to say the majority of the companies, the cash is always low because they're always spending the money to grow, which is fine, but just have discipline in how you use your cash. Any questions on that? Nope. Right, next slide. So this example, which I like to show to people, is a cash flow. Now, this cash flow is probably different than what you're used to seeing. This cash is basically taking the starting point is your net income or loss, and it's basically showing the change in cash. So here are all the different components that go into a cash flow that we would see in a financial statement setting. And it's basically plus minus all the way down down the spreadsheet until you get the cash change between the beginning of the period and the end of the period. So if you have any questions on this, we can go further offline, but this is a cash flow that we typically use in our financial statements that we put together. You, as an owner of a company, would probably do a cash flow model a little different. You would just say, this is how much money I have at the opening, this is how much money I have at the end, this is what I'm going to spend the money on, and this is how I'm going to get there to the end of the year. This cash flow model is basically showing the ins and outs of all the different components on the balance sheet. The receivables, the inventory, the prepaids, the payables and the liabilities, your fixed assets, if you actually own your equipment or you're going to buy equipment, which is a cash flow out. And then you have your financing activities, which is basically all your debt, your credit cards, your lines of credit, your investments. So the financing is all your debt and equity instruments. Your operating activities is all your current assets and current liabilities, and your investing activities is your fixed assets. So this is how you measure your cash flow. And at the bottom, it's cash in and cash out. Now, I will say having cash plus and minus at the end of the year is, if you have some cash at the end of the year, it's okay. It's really, as I said before, your AR and inventory. How are you managing that? I hate to see companies have a tremendous growth in the inventory because then you're not managing your cash flow. You want to have your inventory turning as much as possible during the year. So if you manage your inventory the proper way, your inventory should have a very small growth year to year. Your receivables is a timing issue. It's how quickly you're turning your receivables. And again, a lot of it is timing. If you have a lot of sales in December, the accounts receivable is going to grow at the end of the year. But again, it's about cycling your AR. How quickly do you turn your AR? Your ideal AR and inventory turns should be probably 30 to 40 days if possible. If you're sitting there with inventory that's out there for 3 or 4 months, you have too much inventory and you have stale inventory. So this business is, you got to keep the inventory and AR turning as quickly as possible. Next slide. Brent?
No, Steve, that's you.
Oh, Megan, sorry, my bad. I keep forgetting. Okay, growing pains. These are the 4 issues that come up in growing pains in CPG. A lot of clients will start out as I'll give you an example, in New York, and they say, we want to expand into other states. With that, there are a lot of growing pains. And the biggest hurdles you have there is registrations in various states to do business in those states. because when you grow into other states, and whether you hire people in other states or move your inventory into those states, you have to make sure you're registered in those states. And it's a process that you use in the state. Each state has their own form and also has their own requirements to register in those states, but this is a growing pain. We get called into various situations where we're saying, we want to expand, we're going to grow into other states, can you help us? And we say, okay, we can help you. We can't do we don't do the registrations, but we point you in the right directions of how to register in those states. So it's payroll, if you have payroll in those states, it's sales tax registrations, if you have sales tax compliance in those states, and it's also inventory and sales if you have sales and inventory in those states. That's a key issue, and it comes up all the time. Managing more stakeholders, okay? When you were young and you only had you and your friend, it was great. You managed the process. If you start raising capital and bring on other parties, now you have to worry about other people who want the information. Most companies, when they get more stakeholders, they'll establish a board of directors, in the which means you'll have a board seat, but you have to give them information on a monthly basis to help them evaluate the business and ask for guidance in that business. So more stakeholders can be a good thing, it could be a curse if things aren't going well. Supply chain. This is coming up more and more. Supply chain issues were prevalent during COVID, and even in the last 18 months, supply chain issues are become more and more of an issue. One of the things that we recommend is hire a supply chain expert out there who can manage this process. As a founder of the company, you can't do everything. You can't run all hats. So we recommend you hire somebody who knows supply chain, because this is your lifeline. If you can't get the materials, supplies to your co-packer or your manufacturing plant, you can't succeed. You can't fulfill orders. Your product won't be on the shelves. This is a fundamental issue that I'm seeing more and more, as that my clients will tell me, I have all the sales I want. I can't ship because I can't get the materials. This is a fundamental issue. Managing supply chain is a huge issue, especially as you grow very quickly. When you say inventory, okay, I have a question from the chat room. Yes, when you say turn AR or every 40 days, you mean get paid for your inventory? Yes, that's what I mean. So if you sell your inventory and your terms, and you have terms with your products, on your terms with your AR, you got to manage that payment within 30 to 45 days. Because if you don't get paid quick enough, you can't use the money to go out and buy other material as you grow. If you're able to have a line of credit with a bank or a financial institution, this problem is probably less. But if you can't get outside money to fund your purchases of supply, your AR is your lifeline. Some companies negotiate discount terms to pay in 14 days or 10 days. But if you have typical 30 to 45 day terms, you gotta manage that process. And what I've heard out there in the street right now, there are certain customers that are really paying more like 60 to 90 days, which is not good for you. But that's what they're doing now. They're stretching out the payment to you, because whether they can't get paid from their customer, or they can't sell the product through at the retail level, everybody's extending the payment terms. So this is very key to make sure your AR is getting paid within 30 to 45 days or within term. That's what it comes. That's the answer to the question. Did I answer the question the right way? Thank you. Okay, so high internal resource within the company growth. We've seen companies grow from 2 employees to 100 employees very quickly. And it's vital that you have the proper infrastructure built. And when I say the infrastructure is, there are 4 or 5 key people as you grow through the business. The CEO is important. a financial person, whether it's a VP of finance, a CFO or a controller is vital, but also make sure you have an operations person and also an HR function. HR is the bane of existence in a lot of these companies. If you're in certain states, the states have certain rules about employment, employees and employment engagement. Make sure that you have the proper HR function put together, because I'm telling you, certain states, and I can point out California is a very difficult state to do business in. If you're in New York, you have your other rules. Every state has rules regarding HR, employment, employee, employment, insurance, health insurance, HR, critical function to a business. You also want to make sure that from a legal side, I always make a comment, make sure your legal advisors have a great trail of documentation. Make sure every document is in a file. They can find it. It will come up down the road. So legal is a huge issue to deal with from a company perspective. I like to tell my clients, make sure there are three main functions. Make sure you have a good CPA, hire me. Make sure you have good legal advisors, and make sure everything is in place from a HR function. Somebody's in the chat room. Nope. Oh, that's the question. That's what I say about internal resources. Critical, very critical. I mean, I've seen it. Brent's seen it in the conversations. Critical to have your infrastructure and a sound internal foundation built as you grow to the exit. Next slide. Okay, internal accounting lifestyle. I touched on this before. I'm not going to talk much about this slide, but it's in the slide presentation. But this is just I touch a life cycle of how you do internally about directors, operations, bookkeeping, CFOs, internal staff, and how it all plays out. Okay, next slide. Okay, I'm going to leave this for the presentation. This is a typical income statement example that we like to use, and up top is where the gross sales into the net sales. But we can talk about this if you want to email me after. We can always have a conversation about this also. Next slide. Okay, this is just a slide about whether debt or equity is right for you. I'm going to leave this off again because this is a real philosophical conversation about whether you want to use debt or equity to raise capital. And again, this is a conversation that you should have with your legal counsel and your accountants off to decide what's the best approach. Next slide. These are 5 mistakes that are seen in emerging brands. The first one is just to make sure your capital table is maintained properly. Most people we refer to CARTA for that. Sales tax compliance. We always advise you to go to Avalara or tax outsourcing company that does great on the sales tax compliance. 3, 4, and 5 are very specific issues that come up that we can talk to post this event, because time is we're halfway through the event, and I want to leave time for Brent for tax. So these are 3, 4, and 5 are issues that come up all the time. Next slide. Okay, this slide, again, this is just pointing out different presentations of different costs out there. And I can only tell you that number 2, slotting fees, is the biggest bone of contention out there. But I will tell you, slotting fees under accounting rules is a gross to net sales adjustment. Next slide. Let's flip the slide to get to the tax. I'm going to turn over to my tax colleague Brent to take you through the tax matters agenda.
Thank you, Steve. So as I mentioned before, thank you everyone for your time here. As Adrian provided us the list of all of the individuals here, I've realized that some companies are starting off and some companies are very much mature. And what my goal here through this presentation is to at least give each and every one of you a tidbit of information that either would require you to have a discussion either with your advisors, or if you just need some clarification, of course, you can always reach out to us. And then also at the end of this, I'm going to provide you with some of the issues, quite frankly, that have been most prevalent in our practice, I would say over the last 6 months. So again, to hit everyone who's on this call, we're going to start off with entity selection. Then we're going to talk about state and local rules, SALT, qualified small business, stock, and finally, the top 5 pitfalls and oversights that we've seen. Ashley, next slide. So essentially here, typically what I see in our practice is that a client comes to us and they're in one of these forms. Partnerships, and partnership for taxes is an umbrella that includes general partnerships, LPs, and also LLCs, S corps, and also C corporations. And quite frankly, where I spend most of my time is actually in converting these entities into another form. And that's because the proper advice wasn't given to you as a client when you started your endeavor. So anytime I'm speaking to a client and they are considering a new venture, the first question I always ask, and you should think about, is what's the end goal? If the end goal for you is that you're trying to build a brand that is going to sell to a strategic, well, that's going to have a very different, I would advise you on a very different structure as opposed to creating a business that wants to be a family-owned business that will continue for generations. And then from a tax perspective, the Tax Cuts and Jobs Act of 2017 has made this analysis for us a little bit more complex because one, of course, the corporate rate has dropped from 35 to 21. For pass-through entities, there is this 20% deduction known as 199 cap A, but also what has occurred is the increased popularity of a provision called qualified small business stock. And I will mention what some of those benefits are later, but this slide here, I just wanted to give you guys the ability to weigh the pros and cons of operating in the various business entities that are out there. Next slide. So if there is one place that I spend more time on outside of converting entities, it's in the state and local taxation area. Quite frankly, it's because following federal law is quite simple, right? There is one book out there, the Internal Revenue Code, which dictates how transactions, entities, everything should be structured or operated. However, from the state and local perspective, what you have is you have 50 different states that all have their own methods for taxing. And quite frankly, when it comes to sales tax, you may sell a product in a given state, which could be exempt, but in an additional state or a separate state, that could be a taxable item for you. Now, with regards, one comment I'd like to make. In the United States, quite frankly, if a dollar moves, it's going to be taxed. If you're gifting a dollar, it's going to be taxed. If you're earning a dollar, it's going to be taxed. So with regards to that, what I'm focusing here to begin with is sales tax. And what I would like to mention is that the nexus or threshold that requires you to follow the rules with regards to sales tax is very much different than the rules related to income tax and also franchise tax. Next slide. So with regards to state taxes in general, for you to have, for a state to have the ability to tax you on a particular item, and when I mean particular, I'm talking about a franchise, income, or sales tax, you need to have nexus with that state. And my mom would say that's a $20 word that just means you need to have some kind of touch point with that particular state. Now, that level of touch point, quite frankly, varies depending on the type of tax we're talking about. But recently, there's been a Supreme Court case, a very famous one called Wayfair. And what that case has essentially done, it has reduced or lowered the bar for states to define you as having enough nexus with that state for them to assess a tax, albeit sales tax, income, or a franchise tax. Next slide. So a very popular question that I get time and time again is, with regards to sales tax, when do I know that I'm required to file? When do I know that I'm required to remit sales tax? And quite frankly, what the states have done post-Wayfair is change those thresholds. So quite frankly, years ago, it used to be 500,000 or even $1 million for you to justify, or for the state to justify that they can tax you. And after this court case, the Wayfair Supreme Court decision, states have started to lower and lower that threshold. And on this chart, again, materials that you will have, it shows that for certain states, it's $100,000, or quite frankly, Louisiana, for example, currently shows it could be $100,000 or 200 transactions. So if that food or beverage or product that you're selling is, let's say, $1 for your product, well, quite frankly, 200 transactions will only amount to $200 of sales, but under Louisiana state law, you would be required to file sales tax returns for those transactions. Next slide. Another common popular concept that is out there right now is called the pass-through entity tax. And this applies to any of the individuals here in the audience who are operating as a pass-through entity. Pass-through entities are defined as sole proprietors, partnerships, LLCs, and S corporations. And essentially what this is a workaround to the state and local cap. And for those who aren't aware, as an individual, your state taxes and your property taxes are limited to a $10,000 deduction. So what the pass-through entity tax does is, for business owners who are generating income, your entity, the LLC or S Corp, will pay the state taxes of its owners on behalf of its owners, essentially allowing you to claim that deduction and avoid the limitation that would occur at the individual level. Again, my focus is to run through the slides to open this up for Q&A. And if this is something that you'd like to discuss further, I'm more than happy to have that conversation with you. Next slide. That's more background information. As I discussed, it's a tax strategy to work around the $10,000 state cap. Next slide, please. This slide and the following slide is showing the shift that has happened amongst the states. Prior to 2017, the only state that had a pass-through entity tax concept was Connecticut. And every day, quite frankly, more and more states are moving towards this regime. This regime also is scheduled to sunset at the end of December 2026, with all other provisions, most provisions related to the Tax Cuts and Jobs Act. Next slide. As I mentioned earlier, when we were talking about entity selection, I always ask clients, well, what is the end goal in mind? And for those clients who are considering to sell to a strategic, the qualified small business stock provisions is something that you should be aware of, not only for you as a founder, but for you as an investor. I am sure there are people within the audience who may have operated as an LLC, and when they finally received that first, let's call it Series A round check, call it $1 million, call it $5 million. One of the requirements of receiving that check was to do what? Convert over to a C corporation. One of the reasons why the investors don't want to wait for you and your accountants to provide them K-1s, which could hold up their filing obligations, especially if this is a large venture fund or private equity fund. And quite frankly, also it's because of this provision. For an investor who makes a contribution or an investment into a qualified small business and holds on to that stock for 5 years, they have the ability to exclude $10 million of capital gain from that sale. Or for those individuals who are in the venture space, going back to my example of a $5 million check that's been provided to you, well, it's 10 million or the greater of 10 times your basis. So for that fund that just provided you a $5 million check, on an exit, they're going to be allowed to exclude $50 million from a potential sale. Next slide. Right. And how I'd like to wrap this up is just to talk about some of the issues that I have seen within the practice, within the industry over the last 6 months. And here there are. So first and foremost, capital table management, cap table management. Steve and I are currently working with a client who has gone through a painful process in understanding and cleaning up their cap table. And this mistake has cost them in excess of $200,000 just to figure out who owns what. Equity compensation issues, very popular, right? As startup companies, what are you trying to do? Steve Plattman mentioned how cash is king. Well, if you are trying to attract and hire strategic hires, very talented individuals, and cash is not something that you can provide, quite frankly, your other option is to provide them equity compensation so they can have skin in the game. However, there are tax considerations as it relates to providing equity to an employee, and also what type of elections that they can take for this award to be beneficial for them on an individual level. Unintended consequences. Unfortunately, right now, we know our friend Jerome Powell has been increasing the cost of capital throughout the year. And with that, what we have seen in the practice is some companies, some brands have had to make the hard decision to close up shop. Well, although you may not have any more value or dollars within your business and you think you could simply just close the doors, unfortunately, there may be tax considerations to that. So for example, if you borrowed money from an individual or from a bank and you utilize that in the business and it generated losses, well, if you walk away from that debt, there's a concept called cancellation of debt income. And that can be an unattended consequence for you and also for your investors, depending on what type of entity you're operating in. The fourth point that I have, do not leave money on the table, right? So quite frankly, when I have conversations with founders and we talk about R&D, the first idea is that I need to have employees that are walking around in white lab coats. And that is not the case. That is not the requirement. And even beneficial for startups, more beneficial for startups, R&D tax credits can be refundable, meaning the US Treasury Department would put cash back into your operating account, which quite frankly would reduce your cash burn. The ERC, everyone is very familiar with this concept here. However, it is a complicated area, and I would mention to you, because we're seeing this in the practice, the IRS right now is enforcing this provision by looking at all of these applications that have gone through over the last 2 or 3 years claiming the ERC. And the Biden administration, quite frankly, has increased the statute of limitations to 7 years, allowing the IRS enough time to go back and review all of these applications. And then finally, for the founders that are on this call, you're negotiating with a strategic. They tell you that they're going to provide you $100 million as the purchase price. You do a back of the envelope calculation and you say, all right, 30% in taxes, I'm going to walk away with $70 million. I would strongly advise that you keep your advisors, especially your tax professionals involved, tax advisors, because there are unforeseen issues depending on the entity that's being sold and what's held by that entity that can either make your sale treated as a capital gain, which is subject to the 15 or 20%, depending what kind of taxpayer you are, or ordinary, which can go as high as 37%. Next slide. So here is just our information if anyone wants to reach out. But most importantly, what I would do now is open up the floor to any questions that you guys have. And if you don't feel comfortable asking the question here, I'm more than happy for you to send Steve or myself an email, and we can answer that question for you. But before I answer any question, I will have to say, as my general counsel would advise, I am only explaining the rules that apply, and I am not providing advice to anyone on this call.
Thank you, Brent and Stephen. Great presentation. Opening up again to Q&A. Anybody have any questions they'd like to ask our panelists? Don't be shy.
Brent, Alex, Christopher here. Can you hear me?
Yes, I can hear you clear. How you doing?
Beautiful. Brent, can you give us an idea about QSBS in general? I understand the concept, but maybe just types of businesses that typically qualify for this, or when we're speaking with our founder friends and such, who typically falls into that bucket?
Great question. And what I will do is be a little bit more specific, because this is the Naturally New York organization. So most of the potential members here are going to be operating within the food and beverage space. So let's say, for example, you're a branded food company, or you're in manufacturing. I am comfortable enough to let all of you guys know that you would qualify. The individuals that are, let's say, for example, in the agricultural business, you're growing that food product. Unfortunately, that is one of the areas that does not qualify for the qualified small business stock provisions. But for those that are making beverages, food, manufacturing food or beverages, and selling to retail or D2C, those trades or businesses would qualify. Areas that do not qualify, unfortunately, the accountants, we don't qualify, the attorneys. Sorry, I'm just looking at the questions here.
He's right. Andrew posted something. Yeah, he's right.
Right. So that going back to Alex's question, so that's Chris's question. That's a focus on the industry type. Andrew, who just dropped something in the chat, mentioned that there's this concept that the gross asset value of that entity immediately after a contribution, after capital has been raised, cannot exceed over $50 million. So in other words, if I started a company, Steve and I started a company, and currently on the books was cash and $10 million of inventory. Well, if I went out to the market and decided to raise $20 million, the analysis is take the assets currently on the books, which would be the $1 million of cash plus the $10 million of inventory. You add the amount that has been raised, which is the 20 million, and as long as that amount is below $50 million, then it will still be a qualified small business for the new investors on the round that just closed.
Let me just clarify. Brent, I'm not sure you brought this up. You have to be a C corporation from this. You cannot be an S corporation and convert to a C corporation. Correct?
That's correct.
You must be a C corporation from inception, or convert from LLC to C corporation, and then the period starts on the conversion date. So if you're an S corp, we have situations where clients came to us as S corps and converted to a C corp, and they're very upset that they didn't get the right advice when they did form the company. And we said the rules are the rules. You don't qualify.
And the rule that Steve is referring to is something called original issuance requirement. So essentially what happens is that as a taxpayer, as an investor, I am required to provide consideration to that C corporation. Consideration can be cash or property in exchange for that C corp stock. So because that C corp has provided me the original issuance, as opposed to acquiring it from an investor on the secondary market, that is one of the requirements as it relates to qualified small business stock.
Brad, there's a question in the chat for you. Do testing labs qualify?
RV, if you don't mind, if you can unmute yourself, I'd like to get a little bit more details on exactly what that business is doing.
Hi,
Hi, how are you doing? Good afternoon.
good, thanks. So we test like microbiology, chemistry testing
Mhm.
for a lot of these samples, and we've been in the space for a long time.
How long, if you don't mind me asking?
Over 80
Oh,
over,
You said over 8 years?
over 80 years, but
Oh.
we're more in pharma and NutriWorld, but we're trying to get into this space. And you know, it's definitely something new for us. So we're trying to see how we can come into this natural space.
Very good question. So the reason why I asked you when this business has started is because for businesses that were created prior to 1993, which was when this provision was enacted, unfortunately, this provision would not apply. However, what I would suggest is that if the company is making a decision to enter into this space, the natural space, is that you start with another entity, right? It could be an entity that's held under the group. I'm not sure what your structure is.
Yes.
And maybe you can have the founders of your current structure, individuals, or any non-C Corp taxpayers be the owners of this new business. And there is where you would be able to qualify.
Okay, then we would be able to, because we are thinking that there will be a new entity and
it's almost a better structure. It's almost a better structure to have a separate entity because it's a separate business.
absolutely.
And for those individuals on the call that are operating as LLCs, although you do not qualify in your current form as a QS, as a qualified small business stock, there are very interesting positions and benefits of converting that LLC into a C corporation and maximizing the potential exclusion that you could receive. Any other questions?
No, thank you so much.
Of course, glad to help.
Anybody else have any questions that's wants to ask, or you can always email us separately for questions.
I also wanted to mention that Anchin is offering office hours. So there is a Calendly link in the chat if you would like to schedule a meeting with them directly. I believe the time period is next Tuesday, August 15th, between 11 and 2 p.m. But if for any reason, of course, that doesn't work for you, just please reach out to schedule with them directly.
What are your thoughts on having separate entities for some? Okay, that question, Laney, what are your thoughts for having separate entities for self-manufacturing side versus the brand? So are you in a situation where you have a co-packer, you own your own manufacturing facility or co-packer, and you have a branded selling side, a brand business on the other side?
No, I would be considering making it myself and not using a co-packer.
You're right. You would own your own facility. You would do
Yes.
your self-manufacturing, but you would, that company would own the equipment and the
Yes.
process, right?
Correct.
And then you would sell to the other company, which basically had the brand, right?
I would be creating my own products for my own brand.
Right, but you
So
the
no
brand,
white labeling.
right, I understand, but you would the manufacturing company would then have to sell it to the other company to sell
Oh yeah, I guess so. Yes.
because you have two separate entities.
Yes, correct. Thank you.
And
So you could do
That's
by the way, I will tell you more and more of our clients are actually doing that now. We've had several transactions in the last 12 months where our clients have bought their manufacturing machines and facilities from their co-packers because they want to control the process from start to finish. And they believe they can save money over the long term by cutting out the additional tolling charges and the profit. Some are doing it very well, and some are experiencing some pain because they have to hire their people. It's a lot of material wasting, but we do see clients have that set up more and more now than before.
And Laney, some other considerations there, because quite frankly, someone came to me on Monday with this same question. One, when you own the manufacturing process and you also own the branded food company, you're allowed to control the amount of capacity of supply that you can make, because quite frankly, you're on both sides of the coin. But also an opportunity that happened with this client and that could potentially happen with you is that as your business, the branded food company is increasing in demand, if the manufacturing business has additional capacity, you might be able to white label that product to a retailer. And quite frankly, now you have provided or increased the revenue channels as it relates to your manufacturing business. And also what I found is sometimes the founders may own more of the manufacturing business as opposed to the branded food company because they may have investors there. And with that, what it may allow for the founder to do is make a decent living on the fact that you've created value in producing the product as opposed to selling it. So it gives you options there. And I would say just because you may have two separate entities, that it shouldn't dissuade you from considering entertaining that.
Yeah, great.
That's fantastic. Thank you. And would you say that they should be separate, like peer to peer, or should I link them as one of them as a parent company?
Typically in that situation, they would be structured as what we call brother sister. So imagine if, let's say on day one, you own 100% of both businesses. One would be operating as an LLC or C Corp on one side to the left, and the other would be operating to the right. And you would have a agreement between the two, similar to any agreement you would have with a co-man on what the unit price would be, subject to volume levels as you produce that product for the other company. Does that make sense?
Yes, this is really insightful. Thank you.
That's what we're here for.
Any other? Okay, thank you. Any other questions out there? As the hour is 2:00. We could talk all day.
Well, also as mentioned from Adrian, we do have office hours. I would ask you to leverage the Calendly URL and book some time, because this is us giving back to the community. It is, as Steve said, a collegiate community, and we're here to help.
Okay.
Awesome. Thank you again.
Thank you.
Shared some links. We will follow up with the presentation and all of this information. Thank you, Stephen and Brent, again for your time. Ashley for helping to coordinate, and Jenna as well. Have a great day, everyone.